Well, while the government shutdown is over, the cost of living crisis for many Americans certainly is not. The government reopening doesn't really change that. Bank of America research this week shows nearly 1 in 4 U.S. households is now living paycheck to paycheck, and those affordability issues are getting worse for lower-income Americans. A sobering number to report here: foreclosures in the U.S. jumped in October. When real estate analytics firm says that foreclosures are now up 19% from just a year ago. And this comes as the Trump administration is reviewing new ways to make home ownership more affordable. You may have heard that earlier this week, the president floated the idea of a 50-year mortgage loan. Proponents say that idea could lower monthly payments, while others warn it could actually just do far worse, not only driving up the interest payments, of course, over time, but also driving up home prices. Joel Berner is a senior economist at Realtor.com and joins me now. Joel, it's good to have you with me. So a 50-year mortgage, is this really the answer to the U.S. housing issues?
No, we really don't think it is. There's a very small segment of the buyer population for whom this might be a great deal. Younger buyers who want to buy a forever home that they'll be in for something near 50 years. This could be the difference between the price being $200 higher in a 30-year mortgage versus a 50-year mortgage, and might be the difference between them buying a home and not buying a home. But for most folks, it's really not going to do much. And instead, the interest that's going to end up being paid on a 50-year mortgage is 86% higher than on a 30-year mortgage over the life of the loan. So a lot of people are going to look at this and decide that it's just not for them.
Well, absolutely, because when you look at just what they would pay, as you mentioned, this could be maybe a difference of, if we're talking about a $400,000 house, for example, maybe $250 less in payments for a 50-year mortgage at 6% and change versus a 30-year mortgage. But the reality is when you're paying twice as much as the home costs in interest over the span of 50 years, you're not even really building equity over the span of that. So does it even make sense from that perspective?
No, it really doesn't. At a certain point, it kind of feels like you're just renting your home from the bank. And we ran the numbers, and after 10 years of paying off a 30-year and a 50-year mortgage, you'd own about 10% more of your home with a 30-year than a 50-year mortgage. And so being able to pass that along to further generations just gets more and more difficult when more and more of what you're paying is only interest to the bank. And not only are there risks to the individuals taking out these loans, but to the market as well. Subsidizing demand in markets where supply is still constrained could lead home prices to jump really, really high and offset these savings that we were supposed to have in the first place.
You know, in terms of supply, one of the issues that I seem to keep hearing about, both when I'm reading it in the reporting, but also just anecdotally and speaking to people, is for people who have a ridiculously low rate on their mortgage, this is stopping them, right? Maybe from downsizing if they may be empty nesters, or even just moving because they know they can't get that same rate on a mortgage right now. So we've also heard more talk about a transferable or a movable mortgage. How realistic is that? Is that something you could see coming to the U.S.?
That's something that would be very difficult to happen in the U.S. because of the way that the back end of mortgage-based securities work here. It would be difficult, and we'd have to completely reassess the way that we look at mortgages. Because right now, you expect if someone takes out a 30-year mortgage, after 10 years or so, they may sell their home or refinance or do any number of things that shorten the life of that loan. But if it's portable and goes with them, that changes the risk structure and changes the longevity of the loan entirely. And might lead to higher interest rates across the board. So portable mortgages would be great for people who have a low mortgage rate from a couple years ago who want to buy another home. It would really shut out people who don't have mortgages at all, first-time home buyers, or people who bought in more recent times in the 6 to 7% range. And it really would just make things a lot more difficult. It would be great for a few, and it would add to some supply of homes in that people would be willing to move and put their home on the market, but eventually would shut other people out.
Yeah, I'd love to get your take, too, on this number that we got, that foreclosures are up 19% year over year. That seems really high to me.
I think it's just a function of the affordability crisis we're seeing across all sectors of living in this country. It's not just housing, it's groceries, it's car payments, it's student debt. I think a lot of people are struggling to put payments together in order to buy homes, and that's why we're seeing that the median age of a first-time home buyer has increased to 40 years old, because for young folks right now, it's just difficult to save away money and get that together for a down payment.
Yeah, absolutely. It's understandable. Joel, really appreciate it. Thank you.